It's great to have you with us this morning. What an exciting August it has been in the markets. Sometimes a sleepy time, certainly not that way for the last few weeks. Right now, we're looking at the U.S. futures point to possibly mixed start. But the headline we just talked about in our newscast on the TSX, closing at a new all-time high on Friday. What a remarkable turnaround here for an index that was down more than 5% at one point this month, now positive in August. And for the year overall, the TSX is up about 11%. If we were to hold these gains, that would keep us on track for the fourth best year in the past decade of performance. And what's interesting is that, yes, we have some technology companies, but the U.S. has plenty more. The S&P 500 has outpaced the TSX this year, in part because of some of those big tech names. But with gold rallying, we've seen a lot of the material stocks doing well recently. And at the end of the day, we'll continue to watch how key sectors, whether it's materials or energy or industrials, perform, as well as financials. And they have a big weighting in the Canadian stock market, and they've got a big spot on the corporate calendar this week. As we are going to roll through the next few sessions, the market will be reacting to earnings from a whole host of the Canadian banks. Remember, TD kicked things off last week. This week, we'll see BMO and Scotia reporting their results tomorrow. Then you've got the likes of Royal on Wednesday, CIBC on Thursday. So it'll be a good opportunity to digest how that sector is faring right now. And for some more perspective on the Canadian market, we're joined now by Brianne Gardner. She's a senior wealth manager at Velocity Investment Partners with Raymond James. Brianne, great to see you as always. And I wonder what you make of the fact that the TSX starts this new week in all-time high territory.
Yeah, thanks for having me as always, John. I think we saw the Canadian stocks are really participating and enjoying this broad-based rally this year, a little bit opposite to the U.S. stock market, which has been a little bit more carried by a handful of names, as you mentioned, that Magnificent Seven. And I think we saw TSX was up last week 1%, S&P 500 up about 1.5%, NASDAQ around that as well. So we have seen markets recover from that sell-off we saw about 3 weeks ago. And the TSX we saw rise to an all-time high on Friday, with really energy and financials contributing to the broad-based gains. And I also think, assisting that was the optimism out of the U.S. markets, because we are so closely tied to the States. We saw Powell come out saying that the time has come to lower rates. And I think we saw, rallying across the board there between all the indices. So the TSX is up 11% year to date from a price return standpoint, almost the same as the equal weight S&P 500. But I think it is important to note that the top three sectors make up more than 60% of the index weight and contribute 75% of the TSX year-to-date performance. So they are really controlling the direction of the markets. And we like to call them kind of the Northern Six. Everyone's talking about the Magnificent Seven, so we've decided to come up with the Northern Six Canadian stocks that have really helped lead the TSX to its record high.
I like that. And I guess if we're looking for the reasons behind the record run, if you had to summarize it in one or two factors, why do you think stock market investors have been pretty positive?
Yeah, I think looking at even the top three sectors carrying the TSX, energy, has contributed about 3.3% to the TSX performance, financials 3%, and materials 3%. So right there, you're over 9% of the 11% return we've seen. I think that the largest companies, if you're looking at Royal, Enbridge, CNQ, TRI, that have helped push the TSX higher. I do think that, financials is a big industry in the TSX. And as you mentioned, we're going to continue to see earnings out this week. The financials make up 30% of the weight and have carried 9.9% of the return year to date. So again, something that we're watching closely. We still believe, to be honest, based on the performance we've seen out of the U.S. stock market for the first half of the year, that the TSX could actually beat the S&P 500 this year, as we're starting to see some indicators turning positive for the first time in 18 months. So we look at something that Bank of America has created, this Canadian cycle indicator that has been positive, and the TSS index has outperformed the S&P 500 60% of the time by over 4% the next 12 months. So again, we see the TSX is trading at its steepest discount to its American counterparties in history. So we are a little bit more bullish and have started to tilt our portfolio a little bit more over to Canada than we've been super overweight US recently.
And I wonder whether or not there's room for multiple sectors to have reasonable performance. The only reason I bring that up is we had a veteran investor, Ken Fisher, on at the end of last week, making the case for tech stocks, noting that on the up days, tech has generally had the best performance. On the down days, sometimes the worst. But if you're bullish on the markets, and he is, then he wouldn't be betting against tech. Obviously, Canada, and you laid it out nicely there, has less tech exposure. But if interest rates are coming down, I mean, there's even been research by the equity research team at CIBC suggesting there's money that could be in things like GICs that might find its way into Canadian dividend stocks. In other words, is there an argument to be made that if it's a bull market, that money could flow into a whole host of sectors? Or do you think investors really are going to have to make some hard decisions on where they need to go for outperformance?
Yeah, I think tech is the biggest industry in the S&P 500, right? More than 30% of the S&P 500 is made up of tech. They have returned about 16.8% return year to date. We still are bullish as well on the markets over kind of the next 12 to 18 months at this time based on the economic data that we're seeing. I do think there is area of opportunities. And especially if we are talking about the U.S. versus Canada, we still expect to see a broadening out of the S&P 500, right? We have seen that narrow market participation, whereas with the TSX, we're seeing a little bit more of multiple sectors participating in the rally, which is showing us, we could continue to see things go higher. And we would like to see that out of the U.S. as well. I think even looking at earnings out of Canada, we saw the TSX 60 emerge from its earnings recession in Q2 with results growing 12% year over year, beating the S&P 500 10%. And I think with the interest rate differential, I mean, we're going to see September what happens with Powell. Our expectations are for a cut out of the U.S. But between the two countries, Canada and U.S., there is this widening economic growth differential that is starting to now narrow. I think conditions are shaping up for the TSX to outperform. So we still like financials, materials, utilities, telcos that should really rise as rates continue to drop. And we will likely see those sectors bounce back. Same thing with energy, slightly positive outlook, and we likely expect to see that kind of stay. So we have 3 more rate decisions by the end of the year. We believe, at least for Canada, there will be 2 more cuts. The U.S., we're expecting to see 2 as well. But again, I think given the work that we've seen out of Canada cutting earlier, the cutting cycle should also result in a bigger boost to the Canadian economy in our view. So, which is why we are a little bit more bullish on Canada at this time.
Welcome back. We're tracking some of the movers south of the border this morning, as we always do. And as we often do, to do that, we're joined by Bloomberg's Divya Balji. She's managing editor for Breaking News Americas, and she joins us right now. What have you got up for us, Divya?
Yeah, I think the first one I'd point out too is Eli Lilly. The stock is up just slightly, a little bit, but I think what's key here is, there is a lot of interest around weight loss drugs. And what Eli Lilly has announced today is essentially that they're introducing vials. They also have shots, but they are introducing vials where patients can go in and put this drug into a syringe and inject themselves as opposed to buying these shots for their specific weight loss drug called Zepbound. What's also interesting here is that there is a 50% discount in terms of pricing in comparison to its shots if patients are willing to take these vials. Now, the whole issue with a lot of these weight loss drugs has been the fact that there has been high demand but not enough supply, and production has been the main thing here. Now, with this vial, the production issue really eases for Eli Lilly, allowing them to give a lower price point as well. So overall, the market is pleased about it. A slight increase in the share price. Analysts have come out and said they are quite upbeat about the latest development. It also puts them ahead of the curve when it comes to their competition. And you look at Novo Nordisk, this hasn't happened yet. So just good news when it comes to this. When demand is high, anything you can do to help with supply is going to help your bottom line.
Okay, let's go to Super Micro, one of the high-flying tech stocks.
Yeah, it's a server equipment provider. You know, it is one of these companies, like you said, it's high flying. Hindenburg has issued a cautious report saying it is short the stock. Now, Hindenburg is quite well known in the industry. It did take up Adani Enterprises, or the group of Adani companies, and that really, you know, sent those shares tanking when they initially issued their report on it. Now, if they're taking on Supermicro, are they going to have the same effect? You know, essentially, we've seen the stock drop almost about 9% when the market opened today, but it has rebounded quite a bit. I think it's still slightly lower at this point. Now, what Hindenburg is saying is there are customer issues. They haven't disclosed any sort of sanctions or any other issues that they're facing. There are some accounting red flags as well that they are pointing out to. But given the rebound in its shares, I am curious to see what the company is actually going to say about this report once they have gone through the entirety of it all. But, you know, again, Hindenburg is a very well-known short seller. It has taken up big companies in the past. It'll be interesting to follow the story for the next little bit.
And what's Amazon doing with respect to podcasts? I understand there's a deal there.
Yeah, Amazon's Wondery has basically signed a $100 million 3-year deal with the Kelsey brothers. These guys are both very big in the football field, National Football League, I should say. Jason Kelsey, the older brother, was with the Philadelphia Eagles. I believe he has retired now. Travis Kelsey is still with the Super Bowl champions, Kansas City Chiefs. He is also dating Taylor Swift. So I think there's a lot of interest around this from that perspective. But I have to say, my husband is a Kansas City Chiefs fan, and I have listened to their podcast, New Heights, which has been around since 2022, and it is pretty funny. They do get to bring on a lot of famous football stars as well, which I think people really like. What's interesting in this deal is Amazon now gets to put in ads both from a video perspective and also from an audio perspective, and that's a global reach as well. So I think that's going to be quite helpful in terms of raising money. But this is a $100 million deal for 2 football players who just started this podcast about 2 years ago. Another similar deal that was announced last week was for Call Her Daddy with SiriusXM. So that host, Alex Cooper, has also signed a $100 million deal for something similar. So is it picking up in the podcast world? I'm curious, but maybe it's just for extremely popular podcasts right now.
And how much of a factor do you think is the connection with Taylor Swift to the Kelsey brothers podcast?
Yeah, I mean, I don't know the numbers, but I can safely say that, you know, we have seen ticket prices go up during the Super Bowl. You know, everybody was hoping to see her. I'm sure people are hoping she will join the podcast at some point. You know, whether or not that actually happens is another thing. I can say that Patrick Mahomes has joined the podcast. I have watched that one. So, you know, it's got a good group. You know, even if he talks about her, I'm sure that sort of raises interest as well. It's really hard to say.
We are exactly 3 weeks away from what is widely expected to be the first rate cut from the U.S. this cycle. Our next guest says that the Fed has clearly signaled that they are ready to cut rates. Talk about what it could mean for the markets. Let's bring in Jack Manley, global market strategist at J.P. Morgan Asset Management. Well, Jack, we came into the year thinking we would have 7 by now. I don't even know how many meetings there were, but, you know, we were going to be all the way down to 3%. Here we are, September. Finally, we're getting the first rate cut.
Absolutely. I mean, you bring up a funny point there, Amber, right? Which is that not only at the start of the year were markets looking for about 125, 150 basis points or so of easing, but just a few months ago, markets were looking for no cuts whatsoever, and even some conversations happening around hikes in the United States. It is very interesting to me that we have more or less split the difference in terms of those expectations. Markets now looking for roughly 75 to 100 basis points of cuts this year. And even more interesting than that, it's more or less exactly what the Fed told us it was going to do at the start of this year. Super interesting that we are back full circle to really where we started, at least from a Fed messaging perspective. And I would agree, Amber, that when we think about Jackson Hole this past Friday, very clearly no more ambiguity about the timing of that cut. It is about to begin.
I know that the Fed kind of won, I guess, in job owning the market and being right about it. And I wonder to what degree they'll exercise caution about beginning the rate cuts. Because remember when there was the carry trade unwind and that big sudden correction that we saw in markets a few weeks ago, 50 basis points. They need to cut by 50 in September. What do you think it's going to end up being?
Well, I think right off the bat, right, we can say that if the Federal Reserve has been anything throughout the course of this hiking cycle, it has been cautious, right? I mean, there are plenty of arguments to make that it started too late in its hiking cycle. There are plenty of arguments to make that it should have started cutting roughly a year ago. And I think you can ascribe both of those things to an overabundance, perhaps, of caution. So without a doubt, looking forward, the Fed is going to continue to be cautious and be very deliberate in what it does with monetary policy. I would also say, right, that Powell has told us many times, and he's told us once more this past Friday at Jackson Hole, that the Fed is going to remain data dependent. And that is extremely important given all the data that are swirling around out there, right? Because for so long, Amber, the Fed was pathologically, singularly focused on inflation, that one side of its dual mandate with Congress. Then to your point, that jobs number comes out a few weeks ago. It's disappointing for July. The market all of a sudden shifts its attention 100% over to labor and says the Fed's got to do something, cut aggressively and immediately to fix things. Well, since then, clearly some of those nerves have been eased, right? We know the markets have clearly found their footing. What I think we need to look for is next Friday's jobs report, because that will help us to see if what we saw in July was just a blip on the radar, or if indeed it was the beginning of something a little bit more sinister in the U.S. labor market. Powell said we don't want any more softening. We heard that again this past Friday. So if August comes in okay, we're likely looking at 25 basis points of easing in September. If it comes in a little bit worse than expected or is a deterioration relative to what we saw for July, 50 basis points, I think, is on the table.
Let's talk about how this is being reflected in the U.S. dollar, because it matters for a lot of assets. I mean, Canadian markets as well, because commodities do better in that lower U.S. dollar environment. Emerging markets are doing better in a lower U.S. dollar environment. Do you think that the dollar is adequately reflecting what's going on with monetary policy, or has it overcorrected to the downside?
I would argue it's probably overcorrected a bit to the downside, Amber, because while the Fed is about to start cutting rates, there are plenty of other central banks out there that have already begun that process. And the Bank of Canada is an excellent example, right? We already have 2 rate cuts out of the BOC. As usual, they were first out of the gate, leading the charge, just as they led the charge on the upswing a couple of years back. There were some discussions internally within the Bank of Canada about how much more they could cut if the U.S. central bank, the Federal Reserve, held rates more or less steady. This idea now that the Fed is going to start to cut and cut by not 25 basis points, but maybe 50 or even 75, I think it opens up the door for Macklem and the rest of the Bank of Canada to ease further this year. We could actually see a total of 5 cuts out of Canada before the year is up. What that means to me is that this interest rate differential between the U.S. and other major central banks out there, including the Bank of Canada, is not going to close up as much as we would have thought even a few weeks ago, when recession was all of a sudden the number one subject. So I would say there's probably a bit of an overcorrection. I don't want to say I'm a dollar bull necessarily, but I do think the U.S. dollar stays strong in this current interest rate environment. Forget about all the geopolitical headline risk out there, which is naturally U.S. dollar positive as well.
Canada currently has only a fraction of the mineral production in place to support these gigantic battery factories being built by the likes of Volkswagen. Our guest says capital is key to unlocking the critical minerals needed to fill gaps in Canada's electric vehicle supply chain. We're joined by Theo Yamaogo, Americas and Canada mining and metals leader at EY. I'm sorry, I made a mess of your name there. Remind us, Theo, how you say your second name.
It's Yamaogo, but you did well, though.
Oh, sorry. Yeah, okay, I panicked there. So we produce plenty of nickel.
Yes.
No problem. But lithium, cobalt, we have quite the shortfall. In fact, we're not producing much of any of either in commercial quantities.
Yeah. So I think I might have mentioned it last time we talked at PDAC that we haven't been exploring for those minerals that much either. So these are new minerals in a way. The same way we thought historically we didn't have diamonds, and then suddenly when we started looking, we found diamond, is how I see the future of cobalt or any other minerals. Like even graphite, we didn't really produce them before. So we need to get encouragement from capital to actually go hunt for those minerals, because we are a very well endowed country. And I'm pretty sure we can find literally anything in this country.
There's moves, of course, to produce lithium in Quebec, for example. Some companies are pushing ahead, but is the supply anything like what we need?
Yeah, I find that the complication for capital, which we talked about last year in our top 10 risk, and I'm pretty sure it'll be coming up again in our fall update on metals and mining, is that when the global prices are not helping, capital doesn't flow to these companies to actually push hard. And I believe that sometime we probably want to think about committing to certain commodities as a country to feed those gigafactories rather than wait for gigafactories to actually import the material from other places where the ESG and responsible mining principles are not the same like in Canada.
Of course, cobalt leaps to mind there, and so much still comes from the Democratic Republic of Congo.
Yeah, absolutely. I think that, again, we need to get exploration companies hunting those, but they need to get financial backing for the market, or even for the funds, the retirement funds, to actually say, okay, we want those gigafactories to be here and also consume Canadian material.
Mining is such a tricky area to invest in, isn't it, though? So much can go wrong, and these pension funds obviously are going to be wary.
Yeah, absolutely. I believe that what makes it complicated is if, in the end, when you think about the supply chain, if the EV makers commit to having sustainable sourcing / responsible sourcing, then Canada is the mecca of this kind of materials, and we need to go get those mines running. And we need to think of it in terms of near-term versus medium long-term. Near-term, the way we approve mines is going to be hard to do near-term, but we need to design that our ambition in the medium term is to be a country that can provide green material that then go into gigafactory to produce the right electric batteries.
Yeah, I mean, the government has paid lip service to it, and they have subsidized some exploration efforts. But it's sort of like China decided more than a decade ago, we are going to rule in this. But it's hard in a democracy, I guess, to have a long-term plan that you stick to.
Yeah, I think some of these topics need to be more of a generational approach rather than the 4-year election cycle approach, right? So we need to think of it as Canadian, and we need to think of it as making a serious impact rather than, I'm sure the industry is very happy with all the incentives that are being used right now. But I think we need more. We need more, and we need more commitment. We need more offtake agreement. We need more, even at the municipal level, things to go in a way of building Canada as a powerhouse for energy transition. You did a global study of mining. You do it every year. Top business risks for miners, and number 2 was availability of financing. Yes. So when you think about capital, you have to think that depends on the commodities. Mm-hmm. So typically, what we see is that the money is not flowing into the right exploration companies or the right majors. And we think that that's critical because we capital intensive as an industry. So we need capital to be aligned so that we can build the green mines of the future.
What was the number 1 business risk for mining?
It was ESG. This year we're trying to reframe it and call it sustainability or responsible mining because ESG is very broad. And what we're seeing is more of communities trying to think through how to have community development sustainably. That also includes indigenous communities, how they work in the mining sector. But governance is also a big deal, how to make sure we're transparent. And last but not least, environment. We've seen some of the nickel being produced elsewhere is very bad for the environment.
In Indonesia, I'm thinking about, and workers treated badly.
Exactly,
too, yeah.
But when we think about Sudbury Basin, we're doing it properly, we're following all the rules. So I won't be surprised that responsible mining, which include environmental stewardship, social license to operate, and governance, still comes up in our fall update on metals and mining.
The S&P 500 index in the United States is set to lock in a fourth consecutive monthly gain today after U.S. consumer spending increased solidly in July, suggesting the U.S. economy remains firm. Our next guest expects strength in the tech sector to continue, but is cautious on consumer staples. Young-Yu Ma is Chief Investment Officer at BMO Wealth Management, and he joins us now. Young-Yu, thanks a lot for joining us. What is your take on this month we've seen in the markets? It began with investors very apprehensive about a possible rapid slowdown in the U.S. economy. Stock markets plunged, and then they just rallied all the way back.
Yeah, thanks, Paul. It's great to be here. Yes, we did have quite a start to the month and a reversal that was quite dramatic. We do think that that growth scare was very much overblown. We think that the underlying fundamentals of the U.S. economy and the markets remain healthy. Certainly, there could be a bit of soft patch or choppy data over the next couple of months, especially with the amount of election uncertainty that remains. But we do think that as we get toward the end of the year and into 2025 with rate cuts, with corporate spending, there's a lot that's coming into place in a favorable way.
You said in some recent commentary that there is substantial room to cut rates. How do you reconcile that view with what sounds like a fairly optimistic view on the state of the U.S. economy?
Well, inflation has just come down very significantly, and I think the Fed is realizing that, and we are seeing some weakness at the margins of the labor force. And Chair Powell, and I think the rest of the Fed as well, does not want to see economic momentum build to the downside or some of that labor force softness permeate more broadly. And given how high interest rates are right now, they're just very restrictive. And there's a lot of room to bring rates down, not just into the end of this year, but throughout 2025. But we think even with that, interest rates coming down, inflation is going to stay down, and growth can accelerate with low inflation in the current environment, not both this year and into 2025. So we think those two actually fit together, which paints a very healthy scenario for the economy and the markets.
Is there any potential here for equity markets to be disappointed at the pace of cuts from the U.S. Fed? I mean, the market became excited about the prospect of rate cuts way back in late October. And at that point, the S&P TSX Composite Index was trading at 4,100 points. Now we're at almost 5,600 points, and a cut has not been made yet. There's a strong anticipation of one coming in the middle of next month, but we still haven't seen cut number one.
Yeah, the markets have really just powered through. And the reason is the underlying fundamentals of the economy remain strong. Demand remains strong, spending remains strong, and inflation, even though we didn't get the cuts that the market was anticipating, or at least as early as the market was anticipating, inflation still did come down on a reasonable trajectory, other than a few bumpy months earlier in the year. So that was a healthy backdrop for the market. Could the market be disappointed? It could, but we think if that happens to be the case, if we get any signs of labor market weakness, the Fed is likely to accelerate its rate cutting campaign and probably pretty quickly reverse some of that disappointment that could creep in. So we're not overly concerned that disappointment would lead to downward momentum because the Fed just has so much latitude right here to cut rates over the next year.
Okay, in terms of equity markets, you and your team like U.S. infrastructure and the tech sector. Why so?
There's a lot of spending that's going to continue to flow into U.S. infrastructure. Some of that is government related, but also private sector related with onshoring, a lot of building up of the tech industry, the nuts and bolts of the economy continue to be strong. And of course, the grid build out, which is going to be very significant given AI demands and data center demands as well. So we think U.S. infrastructure continues to do well. And the tech sector, we think, is still in the early stages for AI spending. Right now, most of the spending is coming from the mega cap tech companies, a handful of mega cap tech companies. But what we think is going to happen in 2025 is that spending is going to spread out very broadly across the U.S. economy and among corporations that are really trying to ramp up some of their technology strengths and efficiencies, and that a lot of that spending is going to be directed toward AI, but the budgets are going to start increasing and new projects are going to start flowing once we get some of the near-term uncertainty behind us. So we're quite optimistic that that spending is really going to broaden into the next year.